It is on. Yes. Okay. I think we're good to go. Hello and welcome everyone. My name is Marilyn Heratz-Beasley and I am a Senior Climate Officer in the European Investment Fund, which is part of the European Investment Bank Group. I'm very pleased to welcome here today everyone in the room and also online on the panel on physical climate risks with a focus on key elements for adaptation. Physical climate risks are risks related to the direct consequences of climate change, such as the risk of wildfires or sea level rise. We have also another major category of risk, transition risks, which are linked to the transitioning of the low carbon economy, such as regulatory risk or risks related to technologies. While both are equally important, we today focus on the physical climate risk. Earlier this year, the Intergovernmental Panel on Climate Change in the sixth assessment report concluded that global surface temperatures will continue to increase until at least the mid-century under all the emission scenarios considered. Now, when we think about the recent extreme weather events that we have witnessed around the globe, like the floods in Pakistan that left 8 million people displaced, or the extreme heat waves we had here in Europe that led to approximately 16,000 deaths, another increase in global temperatures seems like really extreme. And it's actually also very scary. So, and all of this, of course, is also what comes with the price tag. So this can lead to really significant losses, both to the companies, but also to the financial sector. And I'm very pleased to have here with me today 5 experts from international financial development institutions, and I'm really looking forward to discussing how your institutions are really adapting to the changes in the climate and managing the climate risks. Maybe I just let you yourself introduce. I give you the floor and maybe also ask you to elaborate on how your institutions are assessing the risks of climate change in your operations, and in particular, the physical risks. Maybe I start on my furthest, Irina.
Thank you. So my name is Irina Likhachova. I am with International Finance Corporation. I'm with IFC Climate Business Team that looks at both climate mitigation and adaptation. Just for those of you who might not be familiar with IFC, we're part of the World Bank Group, and we share the mission of the World Bank Group to end poverty and increase shared prosperity. For us, climate change is very much at the heart of development, and is a core priority across all of the institutions of the World Bank Group. Our strategy is articulated in the World Bank Group Climate Change Action Plan that sets a target for investments that need to go towards climate finance. It's 35% of all of our financing, and I'm happy to say that last fiscal year the World Bank Group invested nearly $32 billion for climate finance, which makes us the largest single source financier for climate in emerging markets. But the World Bank Group Climate Change Action Plan also articulates our commitment to align all of our operations with the goals of the Paris Agreement. So for IFC in particular, we are aligning 85% of our operations by July 1st, 2023, and by July 1st, 2025, 100% of IFC's operations will be Paris aligned. And so to answer your question, do we have a framework for assessing physical risk and look at resilience and adaptation? It falls under our Paris alignment frameworks that look at both mitigation and adaptation. And in order to be able to assess whether a project meets resilience and adaptation goals, whether it's Paris aligned, we first have to assess physical impact of climate risk.
Hi, my name is Ilen Meirovich. I am the head of climate change at IDB Invest, part of the IDB group. We are a multilateral development bank working with Latin America and the Caribbean. And similar to IFC, we also, at IDB Invest, focus on the private sector and supporting private sector in the region in their strategies to raise ambition for climate action, among other things. Let me tell you about what we're doing with physical risks and climate risk screening in general. I have to say that one of the main messages is that this is a journey. We're all learning. The more data that comes out, the more that we can establish and create tools to be able to apply to the screening, management, and answers to the climate physical risks that we are seeing today. And so when did we start the journey? We started the journey in 2016. We had a commitment of slowly ramping up the screening of all of our transactions by reaching to 100%. We're not there yet. We still have a lot of it to go, but we are having more and more capacity building and tools within the institution to be able to get to that goal in 2025. As a process, we included the climate risk screening, physical and transitional risk, as part of our IDB Invest sustainability policy that started to be implemented in 2020. And the way we do it is a three-step approach. We screen the projects, we analyze the level of risk that we are exposed to, and then we identify ways to manage that risk. And within that, we know that certain areas or certain sectors will need more in-depth analysis or tools. So we have identified that ports will require a different type of analysis, and we are designing tools specifically what we call the RAPI port, which is to be able to establish and provide the project sponsors a specific tool to do the analysis. Agri-adapt, agriculture is a different beast. It's just we have to analyze and risk the manage and the risk within the agriculture sector in a different lens. So that all that lessons and all the tools that we had been developed now, similar to most of the MDBs, are going to basically go into faster or turbo drive, let's say that way, because of Paris alignment. We also have the commitment of being 100% Paris aligned from January 1st, 2023 onward. And within the Paris alignment, there is the BB1, which is the mitigation, but BB2 has to do with adaptation. And as we know, the framework that we all had within the Paris alignment work is that first we have to screen, basically, then identify ways of manage that risk, and then propose measures and adaptation and adopt those measures. So I'll stop there because I think we will have a lot of conversation, but that's basically our framework within IDB Invest.
Thank you. Good morning or nearly good afternoon, everybody. My name is Effie Ritter, and I represent the EBRD. Within EBRD, I head and formed what's called the Climate Financial Risk Team. And specifically, what that means is actually we're responsible for the application of the TCFD report across the bank and issuing the methodologies, processes, and implementation of how we assess, manage, and report climate risk. Now, I guess similar to my colleagues here, I think we have a bit of a similarity of thread going across the MDBs in terms of strategic and frameworks that the bank has actually assessed or adopted. We actually look at the TCFD as the leading framework for how we incorporate and assess the various climate risks. So for example, we start on looking on the governance side, where we actually have our board through quarterly reporting that we actually tell them where we stand in terms of monitoring the risks, what is it that we've identified, what's the current exposure that we have, and that's the process that we go. Every project that actually is approved goes to the board, and there is a climate screening and a climate comment on that as well. So that's largely on the governance side of it as well. Strategically, not dissimilar from perhaps what you'll hear as well, we do have two core strategic priorities. So the first one, I think we've heard climate finance from the IFC, and a similar amount also from IDB. We have a similar one that we call it GET, and which is GET finance is effectively a green finance that we provide to our projects, and our target is 50% by 2025. Over the past 10 years or so, that ranged between 35% to nearly 50%. Last year it was 46%, and I think we're roughly around that, hovering around that target now. The second strategic priority is actually the Paris alignment. So similar to other MDBs, we expect to be Paris aligned across all the operations and our projects by the end of this year. So that's the strategic area. Now, moving down across sort of the pillars of the TCFD, if I look at risk management, then we actually have the practices of assessing, screening, collecting the data, and mitigating where possible. Climate risk is within the risk management domain, and that's where we've established methodologies both for physical risk and for carbon transition risk to look at projects and counterparties and assess what we consider their risks are. And then finally, when we go through the metrics, that actually feeds in a little bit to the strategy as well. So in terms of metrics, we look at the 50% GET target, we look at the Paris alignment target by the end of 2022, we look at reducing emissions by 25 million, we look at being net zero in our own internal operations, and we look at actually mobilizing green finance as a percentage of the overall finance that we do. So I'm sure we'll get more into the management of physical risks, but this is the overall framework and a little bit of an introduction to me. Thank you.
Good morning, everyone. My name is Stéphanie Descoubes. I'm working for the European Investment Fund, which is part of the EIB group. As you might know, EIF is focusing on SMEs and mid-caps across Europe. And we do this via intermediaries, and so our main counterparties are banks or fund managers. So I'm part of the risk management department, and I'm leading a team that is focusing on climate risk assessment, ESG risk, and also policy risk or SDGs. As part of the EIB group, we have a climate bank roadmap that was set a few years ago, and this is more or less our plan to fight climate change until 2025. And as part of this framework, we have established an environmental and social policy which sets our targets. And at the EIF, we had to apply this framework to our core business, which is really to help SMEs. And so we have also developed an EIF ESG principle document where we explain how we manage and assess climate risk and any other ESG risks.
Thank you. Eva?
Thank you, Stephanie. I'm Eva Meyerhofer. I am not a climate change specialist. I'm actually a biodiversity specialist sitting in for our climate colleagues. I head the Environment Policy Unit at the EIB. And in terms of our framework, as Stephanie mentioned, what frames our whole agenda for climate action is our Climate Bank Roadmap, which was approved in 2020. And it sets out really the steps in terms of our Paris alignment. We are Paris aligned since 2020, so all our operations as of 2020 have been Paris aligned. For our climate risk assessment, we come at it at a slightly different way from, for example, EBRD. So TCFD indeed is a reference point, but we came at it, first of all, from our environmental and social standards, where already since 2013, very similar to IDB Invest, climate have been mainstream. So already from the onset, at least at project level, in terms of physical climate risk, were being screened at project level. And then from that framework, we then developed the framework for looking at physical climate risk in terms of our Paris alignment. So it is, Paris alignment is really a cornerstone for our intervention, and focuses not only, as Stephanie mentioned, not only at the project level, but at our counterparty level. And it is important to situate really the project within the wider strategic context of climate resilience system. So that's pretty much what we are looking at, but very similar. We have the 50% climate action and environmental sustainability targets that we need to reach by 2025. To date, we already have overshot that target, and the question is, can we do better in the coming years?
Thank you very much. And very, very interesting, and I think it gives really a good start to some of the other questions that I have prepared. Eva mentioned projects. Effie, maybe I can ask you about counterparties, because I think this is an area that you are looking into in your climate risk assessment.
Thank It's good to have a microphone in front of you so it doesn't work. Thank you, and I'm happy to talk about our counterparty approach. I guess perhaps the only thing I'd wanted to clarify is that when I talk actually about TCFD as a framework that we look at to assessing climate risk, I should probably caveat that, because coming from risk management, the focus actually is looking at physical risk from a financial impact perspective. So it's not only the fact of assessing that risk and knowing that that risk exists, but it's actually what is that ultimately going to, how can it ultimately affect our bank? And that's where that big change has happened, because from an environmental standpoint, the EBRD has been looking at climate risk and the impact on its projects since its establishment, and I suspect that similar is the approach for other MDBs. What the TCFD framework actually did is it turned it around and said, we're not looking so much how your project is going to impact the environment, but how the project's, how the physical risk is going to impact the project and hence impact their ability to repay you. And that's why the TCFD was actually a very useful and interesting framework to use, because it looked at that matter. And that goes actually in a bit of a roundabout way into what Roland was asking, which is we do projects, and when we do projects, we assess those projects, and most MDBs are focused on financial flows and being very clear in where their money actually goes. So very little generic use of proceeds, very little money that is going without a clear use of proceeds. And the project flows are very directive, and that's something that we look at as well. But from a counterparty standpoint, and counterparty ultimately means the entity that we are expecting them to either repay us, or if it's in equity, the entity that we're ultimately expecting to have a stake in, the entity, the client, the company that we work with, that we're looking for their financial flows to repay the debt or to be good in the guarantee that they're providing. And that's why when we look at physical risks, we're looking at the counterparties and how exposed they're to physical risk. We have a methodology in place for that. I'm actually not sure if there's a methodology approach where we're looking at each counterparty, what are the geolocations of their assets, what's the vulnerability of the sector to those hazards that have been exposed, and then based on that we apply a score of 1 to 5 to have an indication of the likelihood of that impact to apply and affect them from a financial standpoint. Those counterparties that are screened as having a potential high exposure to physical risk are then assessed further in what we call a second stage assessment. And the second stage assessment is looking at three things. It's looking at, is this risk really material? So while we do use geolocations and we use tools to assess it, and we've published those, the tools that we're using as well, sometimes there are mistakes, sometimes it's not relevant, sometimes you're looking at something that is not as applicable. And as Helen mentioned, actually, this is a journey, so things will need to be iterated and improved. So that's the first step that we do. We've screened it as potentially high risk, and we look to screen it for materiality. Is this really an effective risk for that? Did our system come up with the right answer? That's step one. Step two is then we actually look and see, okay, what is the risk that they're exposed to? And if they're exposed to, let's say, flooding risk, then we speak to our client and see, okay, what are the flood defenses do you have? Are you aware of this risk? Are you doing anything to mitigate it? Some clients would actually say, yes, I'm aware that this is something that's affecting me. It's not something that's new. And therefore, I've put things in place. Either I've built flood defenses, I've got insurance to a 1 in 30-year flood, or other mechanisms that they have in terms of early warning system. And when we see that, then we have our experts actually assess whether this is sufficient to take into account also the changing, so not just the backward-looking floods, but also the changing and the forward-looking expectations of what these climate changes could happen. So that's sort of step three in some of the clients that we have. And the third area is that we have clients that we come to them and they look at it and they're not aware of this risk. And they don't know that this can affect them, and this is actually something new that they're being that we're screening for them and telling them that this is something that happens. And when that happens, that's where the action and the actions becomes a much more important feature. So through working with them, either in determining to move where they're focusing or where they're locating certain assets, because sometimes it could be even as a matter of moving a few hundred yards away on the same site, and you're actually in an elevated path or in an area that some of the hazards won't affect you, or if it's specific and it will capture because that's part of your operations, then we look to see what are the elements that could be applied to help mitigate that. And then we put in an action plan. Like many MDBs and frankly many companies, we have lots of acronyms. For this ones, we call it an ESAP, which is an Environmental Social Action Plan, where we put targets, and those targets are put in place to monitor and address those risks, and then we review them on a periodical basis. So
Thank you.
I hope that gave a bit of an
extensive answer. Thank you. Stephanie, would you like to add anything on what EIF is doing on the counterparties?
Yeah. So at EIF, we have used a methodology that has been developed at group level, so together with my colleague from the EIB. And the main challenge for the EIF is that we have lots of SMEs, like millions of lines, and so it was a bit difficult to make a case-by-case analysis. So what we have developed is a quantitative methodology that is based on anchor scores that have been defined by our engineers and economists at the EIB. For each sector and for each country, we have developed a score from 1 to 5. And within our portfolio, we apply these scores to our exposure. And we do an average, and so as a result, we have also a score from 1 to 5. So this is our methodology. And what do we do with it? So first of all, when we assess a new investment, we disclose this information to the people that take the decision if we want to invest or not, so they can be aware of the climate risk that we have, and they can take a clear decision. And in addition, we also do lots of reporting. So as all of you, we do the TCFD report, where we mention our climate risk scores and we monitor its evolution. We also do some internal reporting as well. And we have also started to integrate the climate risk scores in the risk appetite framework of the EIF, as well as some risk documents related to the liquidity or the capital allocation.
Thank you. I think data was also mentioned at some point, and you mentioned that the methodology has been developed together with the EIB. Eva, do you, for example, use proxies in your methodology? How easy is it actually to implement it across such a wide range of counterparties and the SMEs?
Okay, so I'm going back to the physical climate risk projects because data will always be a key issue. So data will always be a key issue for also at the project level. And especially when it comes to locational data and projections, the data that you need to be able to do this forecasting that Effie mentioned, because we no longer, in terms of understanding the vulnerability to climate and the risks involved, we don't look at historical data, but we do need forward-looking modeling. And that data is missing. So what we have tried to do is we've signed an MOU with the European Centre for Medium Range Weather Forecasts, using also having access to Copernicus data, which will allow us hopefully to have more authoritative quality control data and services and tools to support some of the smart adaptation strategies and approaches. And I think something that Effie mentioned indeed is when we are engaging with our clients in terms of the adaptive measures that they may have, or especially for the clients that are not aware of some of the risks that they are exposed to, is trying to find those right adaptive measures. But in order to be able to do that modeling, and in order for actually our own tools to be able to inform us correctly, we need that robust data and as granular as possible. I mean, this applies not only to the climate area. I mean, it'll apply when we start doing environmental risk screening, certainly, and that whole data. So you will be using proxies. There are certain proxies that can inform you, at least give you a general idea as to where you are placed within the whole resilience system. They are not ideal at the moment, and those challenges in terms of industry data that Stephanie mentioned, especially for SMEs, especially for listed companies that are not listed, you are going to have a number of proxies to be able to include those in your models. Otherwise, if there is no reporting, especially on the SMEs where they are not listed, they are not obliged to report according to the TCFD or any of or GRI even, it's impossible to generate that data. So I'll stop there.
Thank you. I think Helen, you also, you want to add something, Effie? Please go ahead.
I actually want to ask a question. So, so maybe can I ask you maybe to elaborate a little bit on what proxies do you use? Because some of the difficulties with proxies is that they are proxies, and then that is a limitation to it. Would you be able to expand a little bit, perhaps, on the type of proxy and what are the right ones to that you find is the right ones to use?
I don't think I'm able to answer that since I don't use the models, but you're going to have proxies, for example, in your supply chain, right? So you're going to have to make certain assumptions, and now I'm coming at it from the environment perspective, but so for example, if you see, there is in the supply chain keeps on getting disrupted, let's say you are in the agribusiness sector, you see water scarcity being one of the proxies, and can determine that you are in a region that is water scarce and you're seeing continuous amount of droughts. You're not seeing the quality of the food production or of certain cereals. Those are proxies that you can use to inform your models. But I'm going to have to defer to my climate change colleagues on the exact type of proxies, especially I think it varies from industry to industry also. But in the SME business, I mean, it is a huge challenge, especially if we start going down the supply chain as to what are the types of proxies that are robust enough and that we are comfortable with, because the issue, of course, with proxies is the uncertainty that we do have.
Helen, on adaptation, I think you recently published a paper. If you want to mention a bit more about that.
Yeah, thank you. I think that we are learning a lot more in the conversation as well. So it's good to have this discussion. And to the point of adaptation, we know this was the implementation COP. We know adaptation was going to be critical. So we went back to the beginning of our work with the private sector as IDB Invest, and we tried to see what has happened with adaptation. We know there is a huge gap on adaptation finance for Latin America and the Caribbean, and we also know that there is a business case. Of course, it's better to invest $1 today than have to pay $4 tomorrow, and in the case of the Caribbean, that is 1 to 6, So it makes sense, but still, there's not a lot of investment in adaptation. So we went back and tried to see what were the drivers or the roadblocks to invest more in adaptation from the private sector perspective. Part of what we saw is that in addition to having the tools to analyze and the climate risk screening process that would allow to identify if a company needed to do adaptation, we actually saw several things. First, a private sector company may be doing adaptation, but they don't call it adaptation. It's just impacting their revenues, their cash flows, and they're looking for solutions without necessarily knowing what the solution or the best solution is. Part of it is what Eva was saying. They go and look at modeling that is based on historical data, when we know that the issue is that we have to also put future-looking data to know what the potential impacts is. So you may have, designed a road with 100-year drought, potential 100-year drought happening in that area, but all of a sudden the modeling says that you will have more frequent 500-year droughts or floods. So that is part of the conversation. The private sector doesn't know that there is an issue with, or they don't call it adaptation, and as a result, the solutions may not be grounded on a scientific evidence of what will happen. So that's one thing. The other thing that we see is that part of the conversations that we have with the private sector clients is that even when we say, look, you have a risk, you should do something because in year 10 you will have an issue with your port, many times they will say, that's a problem in year 10. We will refinance so many times, we will do other funding, that why should we bother now? And that there's the question of how do we incentivize for, at least in infrastructure sectors, to do part of those investments now instead of waiting for year 10, right? And I think Effie was pointing to it in a way. If we can include the climate risk and see what the financial implications are, or the financial benefits can be, and we price that differential of if you adapt now, if you adopt these measures now, you will have a resilient asset, an adapted asset, and then we go to this extra step to say, rating agencies, you should value this resilient asset or adapted asset better, in a positive way. Then of course you will have the private sector saying, well, if I will get a better interest rate for doing adaptation beforehand because I'm going to have a resilient asset, then you will have more action in that sense. So that's one of the things that we are thinking about. How can we do price differential for assets that are investing now instead of in the future? The second thing I would say is that we're not necessarily thinking about new financial instruments. It's not that we have to design a new financial instrument. We may have within our toolbox financial instruments that we can apply for adaptation. Let me give you an example. We have lines that can be committed and uncommitted lines with clients. And sometimes we have a time lag. We identify the risk, and we want to do a study to see what the options are, the best options for dealing with coastal erosion are. But the hotel already took the line to build the hotel, and the results of the study of what options they could do to make that coastal erosion, manage that in a positive way, comes a year later. So if you give that client a conditional and unconditional line, so basically a part of the line of credit that you give them is for the specific investment that they want, and then condition the second part, the $5 million extra, based on the results of the study, then you have action and you have investment. And then finally, the other point that we have, and of course we can share the link with of the publication, is that sometimes we also have to have what we call the climate clause within the contracts, especially in the agribusiness sector. Because what you have is that sometimes you may have private sector that does not want to get involved in an investing of resilient crops because they don't know if they will have financial stability. So including the climate clause and allowing the client to call on this clause to have a stop on the payment of the principals and allow them for financial stability is also a good way forward.
Thank you very much. Irina, maybe you want to come in as well. I know you just recently published a biodiversity finance reference guide, and how are you taking adaptation into account?
Thank you very much. I completely agree with my colleague that incentivizing private sector investment in adaptation could be challenging, but we have to articulate the benefits to the client. And so let me come back to the biodiversity finance guidelines just in a second, but I just wanted to take this opportunity to explain how IFC looks at climate risk exposure and how this translates into our understanding of financial, environmental and social risks that the projects have in our portfolio. So we recently developed a proprietary tool. It's called GeoViewer. That essentially, it's location specific. We would put in coordinates for our project, and based on that specific location, the tool also, has a variety of climate hazards built into it, and so it gives a high-level view of what climate hazards this particular project at this particular location is exposed. It also looks at these hazards over time horizon, and I think for our clients it's very important to understand, right? I think, yes, when we talk about 100-year occurrence, that's a bit tough to convince the client that they need to invest in adaptation, but if the model predicts, occurrence in the next 5 years, it's a completely different conversation. It also looks at different probabilities and climate scenarios, so different ranges of temperature increase that we can expect. So the tool assigns high, medium, and low probability of the occurrence of climate events, and then we apply that. We kind of discard the low risk probability, but look at medium and high risk. And we have additional tools that look at the impact of that climate event on specific sectors. So, for example, increased level of precipitation will have a very different impact on a hotel versus a road, for example. And what the tool also allows us to do is, and this goes to the question of the cost of adaptation, it allows to figure out what possible resilience and adaptation measures are that the project could take on board, what their costs would be, and what's the impact of those adaptation measures on reducing the risk. And it is extremely important to have this conversation with the client, kind of what's the return on this investment. And that brings me to the topic that I'm particularly looking at, is nature-based solutions as part of resilience and adaptation program. And the World Bank Group Climate Change Action Plan acknowledges that nature-based solutions are very cost-effective in promoting resilience and adaptation, and they also bring significant climate mitigation benefits. And so the World Bank Group Climate Change Action Plan actually commits all of our institutions to increase investments in nature-based solutions across all of the priority sectors, which are food, agribusiness, land and water, transport, energy, cities, and manufacturing. And so what we have done in our Biodiversity Finance Reference Guide, we have identified areas that are accepted use of proceeds under biodiversity finance, under green bond and green loan principles, again with the idea of providing a bit of a carrot for clients as a way to educate them about how nature-based solutions could actually play a role in resilience and adaptation, what are the cost benefits, but also by including nature-based solutions into larger infrastructure projects as part of acceptable use of proceeds, we're essentially helping clients then reduce the cost of financing potentially. And as IFC, we're looking at pilots to help incentivize the uptake of nature-based solutions in infrastructure projects through sustainability-linked finance, where adopting nature-based solutions could be used as KPIs.
Thank you very much. Maybe I jump back. Stephanie, SMEs were mentioned. How do you, would you say that new technologies could help banks and SMEs in their adaptation to climate change risks?
Yeah, thank you, Melin. So basically, at the IF, we definitely believe in startups and in the new technology that could help to fight climate change. So we do lots of investment into this area, and we started maybe first by the mitigation. So we have started to fight against CO2 emissions, and we have some infrastructure funds that, for instance, invest in solar energy. But in addition, we do some investment into adaptation, and we see that this is becoming more and more important. And as Irina mentioned, nature-based solution, indeed, this is an area where we also want to invest in. And as of today, we have invested 700 million into agri-food business and bioeconomy, and we have a target to invest up to 1 billion at the end of next year. So this is definitely one of our targets. And we know, and we all know that in agriculture's innovation is quite low. It's one of the less digitized sector, and we definitely believe that they need help. So as an example, and to answer to your question, Merlin, we also invest in some companies in different sectors that can help these businesses. And recently we made an investment in Spire Global, which is a company that is active in satellite. And so they collect a lot of data from space to the Earth, and they can really help a lot of companies. For example, they can predict hurricane, they can predict the spread of wildfires, or they can predict some weather forecasts. So this kind of company we really believe in, and we want to continue to invest in this area.
Thank you very much. Maybe let's talk a little bit about regulation and regulators. In Europe, the ECB, in its 2022 climate stress test reporting, they concluded that overall, supervised banks have started to integrate climate risks into their stress testing frameworks, but however, they also found that around 60% of the supervised banks that did not yet have well integrated all of this into their risk management systems. And I know you are not regulated as such, but it would still be interesting to see, for example, how different regulatory frameworks have influenced your developments and your climate risks methodologies. Maybe, Helen, I can give you the floor. Sorry.
Thank you. So yes, in Latin America and the Caribbean, the regulation of the market is not the same as for example, having the EU taxonomy, which drives a lot of the investments with banks, and the conversation that probably you have with a financial intermediary in Europe is much different from the one in Latin America and the Caribbean. So we have seen some hints or starting of regulations. For example, in Brazil, the central bank did do a regulation on climate disclosures. In Chile, you have another, Colombia, and you have also other countries that are also trying to start with at least green taxonomies of what it is a green investment. But disclosure is not necessarily part of that conversation just yet. We see some countries, as I said, that are more advanced than others, but it's not necessarily something that is across the region. So when we engage with clients, I think that what we do is try to show the potential and the opportunity that you have if you do disclose your financial risks that you may have in your portfolio. And one example that I would like to bring to the table today is what we did with Da Vivienda in Colombia. So what we did was to link our financing with TCFD disclosure. Basically, we said we will provide you with blended finance or an incentive for you to become part of and signatory of TCFD and do disclosures in the process of the loan, as well as increasing their green lending. I think that the result of that process, while at the beginning Da Vivienda didn't really know what TCFD disclosure was, the result was a very positive outlook because they saw that also it positioned themselves as a market leader, within the 2 or 3 banks that are leading in Colombia. And they actually moved faster than we anticipated. So we had said, the first year you need to just become a signatory, the second year you should do your first disclosure. They moved even faster than one had planned because they saw the opportunity, they saw the potential of doing so. So the takeaway of this is, yes, the markets are moving. We know that the regulations are moving, but maybe in the Latin American context it's moving slower. But still, there is an appetite of banks to learn and to be able to position themselves because they know that with that they can attract capital, because there are, as we know, a lot of investments or impact investment funds that are trying to seek these type of opportunities, and seeing financial intermediaries that are committed to disclosing is key.
Thank you very much. Anyone would like to add, maybe Eva, from the European perspective?
Thank you, Marilyn. From the European perspective, exactly, as Ilan mentioned, of course, we are differently regulated. And I think what the ECB has come out with a number of guidance with regards to how to integrate climate risk into loan origination, for example. But through their assessment, what they have found is that there's been a tendency, or let's say a focus to date on transition risk rather than on physical risk. Because everyone thought, that physical risk would have a longer time period, however, we've seen in Europe in the last 2-3 years the frequency of droughts, of extreme weather events, and so the ECB now is actually pushing those regulated entities to do more assessment of physical risk rather than just limiting it to transition risk. What we are also seeing in terms of the regulation is guidance, especially, Ilan, you mentioned how, or was it Irina, in terms of the incentive and the carrot, but it's in terms of loan restructuring, is also when we start restructuring loans, is how do you then integrate climate risk considerations when you need to restructure some of those loans where you are seeing that they're defaulting on their payments, and making sure that in that restructuring we are integrating again the consideration of climate and looking at the climate risk from not only a physical perspective but from a transition perspective in order to safeguard those assets. Finally, I mean, what we are seeing in terms of the regulation is the expectation by the ECB also is to not only limit it at physical and transition risk, but to start putting it, I think, again, IFC and IDB Investor mentioned this, is that our risk frameworks need to be reflected into our credit decision. So affecting, I think, Ilan, you mentioned it, affecting the pricing and in terms of our loan pricing going forward. And that is something that I think we are very much, and also the other commercial banks are very much at the beginning of that particular journey. I think we are just looking right now at seeing, okay, this is in terms of our portfolio, but it hasn't started influencing our credit analysis and our loan pricing.
Thank you. Would you like to add anything, Effie, or anyone? Yeah? No?
Sure. Thank you. I guess I'm just looking at the question again. So, you know, with in terms of how do different regulatory frameworks and developments impact your climate risk assessment and practices? So I think we're all unregulated as MTBs, but at EBRD we look primarily at those leading regulators. So on our front, it would be largely the Bank of England, but more recently the ECB. As the ones that we look at their regulation and see how we can incorporate them in part of our practices. Obviously, when it goes down to our clients, there are various regulations that come from their different central banks. But the ones that tend to be the leading ones, and the ones that tend to be the ones at the forefront, are the ECB, in some cases the Bank of England as well. And then there's also the NGFS, so the Network of the Greening of the Financial System, which is a network of over 100 of different regulators and different central banks that are coming together and setting up what are the parameters that need to be stressed, what are the actions that need to be done, and those are the ones that we look at primarily in terms of making our assessments and thinking about what is it that we'll do in our projects. Perhaps to give some concrete examples, the NGFS has come up with given actually key numbers for what would be the carbon price that would be used as part of a stressed sensitivity. The NGFS has actually also come up with what are certain events and how to actually apply physical risk as well. So we're using that as a, or actually when I say using that, we're trying to interpret that as best we can to apply that on our projects. I'm going to be very frank and similar to what actually Eva said as well, is that on the carbon transition, they have given actually clear numbers for what the stress should apply. So there is a given number. You can argue whether that number is correct or not. It's not meant to be a prediction. It's meant to be a stress. On the physical side, it's much more difficult because it's much more subject to interpretation and much more subject to own analysis of what we would use. And that perhaps brings me to a final point, which is the challenges in using this. And some of the challenges in doing that is, despite speaking to many of my colleagues here, reading for my pleasure lots of various TCFD reports. When you read those reports, you don't see consistency. You don't see a solidarity, and are you not able to easily understand what percentage of their assets are they actually using, what are the sensitivities and the implications that they are applying, and that consistency and that regulatory aspect needs to come ultimately from regulators. We're noticing it also when we feedback and get feedback from our clients that they don't know what to do. They don't know what to look at. There's a lot of high-level speak in terms of align your portfolios to net zero, align your portfolio to 1.5, but what does that actually mean in terms of how do I set my portfolio to that level? That degree of implementation and that translation is missing to some extent, and that's what we're trying to establish ourselves, and then and as a non-regulated bank, once we get that, also able to apply that and to share that with our clients so that they're able to set their own standards and create their own disclosures in a meaningful way, in a way that actually meets the regulations that they need to do. So perhaps a call for regulators is for consistency, for templates, Recently, there was a template that was set up by some of the capital markets bodies, which was actually quite. It's a free template, and it's an attempt to try and get different clients to work together. Together within our own little community, we actually have a joint MDB, TCFD, and climate risk working group where we actually try to share methodologies and approaches so that at least when you're seeing things that are coming from the MDB, they're actually based on the consistent parameters to the extent possible, and that transparency is there. Also with transparency, that's why when you look at our TCFD report, when you look actually also at the EIB's TCFD reports and others, you'll see the sources that we use. So you know actually which entities are we looking at, which companies are we using, how are we getting that, so that as much as possible, there is a possibility to compare and to understand how the different banks relate to this risk, and an ability to understand what each bank has. So. Long answer.
No, that's a very good answer. We still have quite a good time actually, and we see a bit of movement in the audience, so I'm not sure if anyone at this point would like to come in with a question. Let me just try to get you a microphone, or maybe you can come a bit closer.
Okay, I'm Tangani Chivute. I'm from Namibia, from the power utility NemPower. So we do quite a lot of financing with the World Bank, some of the other banks also here, and I actually had a question with regards to this GeoViewer. So we are obviously seeing, we're doing a lot more climate-related projects. I'm sure you've heard of Namibia's green hydrogen projects, but as a utility, we are also going into biomass, solar, wind. And I just wanted to know, this GeoViewer software, is it free software? Is it software that anyone can use? And if you use the GeoViewer software, do you still need to do on-site validation to sort of validate those long-term forecasting and so forth?
Thank you very much. Is this working? Can you hear me? Okay. Thank you very much for the question. So two parts to it. After we use GeoViewer, do we do additional work on site? Yes. So it's a combination of applying the software, but also having questionnaire. When our specialists go on appraisal, when they're on site, there are additional conversations that we need to have with the client. In terms of whether software is publicly available, not yet. Currently it's proprietary to IFC, but we're working on making it public and hope to make it publicly available for free in the next year.
Then just a follow-up question, because what we are seeing is we simply don't have the data currently in Southern Africa, whether it's long-term data in the past or even when we're looking at early warning systems. And I'm seeing even a lot of our applications within Namibia where we are applying to, let's say, the GCF or any of these sort of climate financing institutes. Everyone is putting in a portion of grant funding for building early warning systems. So what is sort of the latest trends, or what are the latest developments in early warning systems? Have you actually financed the project that has developed these early warning systems, and are we actually getting good, accurate forecasts going forward? Because I simply don't know what is out there at the moment. So yeah, so I don't know who's best placed to answer that question, but
So I was just trying to recall, during the COP right now, maybe last week, there was in the innovation zone quite a lot of data providers and options for early warning systems. And one of the data or the platform was OC Data, I think if I recall correctly, where basically you can see a lot of the information of the impacts that you're having, but it's not necessarily an early warning system. But there were many instances, and I think they are still going in the innovation zone, where you can find options, or you can talk to the people that are designing this type of technologies to basically help with the early warning systems.
I can mention a few to you as well, but in fairness, we haven't tested them. So while I can mention them to you, I can't recommend it. So if you want, I'm happy to actually, this is an area that we probably need to explore, so happy to do that. But that is an area that is still growing. There isn't a standard for that, and that is part of the problem actually in applying those systems as well. But happy to reach out after.
Thank you.
Just let me I think one of the issues that we do have with also and these geolocators and data is that a lot of them are not open source to date. And I think one thing that the European Union is working on in general is trying to make those tools and that data open source. But it's taking quite a bit of time because to date, they're pretty much commercial, and it's bringing those then so that countries that don't have access to those tools have then access to those tools and to that data. But and that's work that's ongoing. So also do liaise with also the donor countries, but as well as with the European Union, because there's a lot of work with the European Space Agency, also the European Environment Agency, working on open source data and geolocators.
I think we have one more question, and as a moderator I can also suggest to look at the Joint Research Center website, because I know they have some quite good tools there as well.
Okay, sorry, I came late, so maybe already discussed my or answered my. Sorry if I came late, so you maybe already addressed my question. So I'll go very quick. My name is Hussam. I'm with the Ministry of the Environment in Egypt. And I just want to know, as EIB is proceeding with supporting climate finance in Egypt and in Africa, since we are in COP, would you have certain percentage toward adaptation project versus mitigation project, or it's a mixed portfolio of financial support? We would be very interested to know if there is a kind of segregation or classification between funds going toward adaptation project within Egypt, within the continent, or versus mitigation project. And I'm sorry if this has been addressed before. Sorry.
No, I think, and I'll pass it on also then to EBRD, because EBRD is also a large financier in Egypt. No, we don't. I mean, our aim is certainly our adaptation numbers are fairly low, but we don't say we need to have particular. Let's say we don't take a country approach and say this amount needs to be mitigation, this amount being adaptation. We have shifted our focus to adaptation. We do want to increase our adaptation numbers. So the more adaptation types of projects that land on our desk, the better. But there's no segregation per se.
Frankly, I can only echo what the EIB has done. We are doing the same thing. We have a target of 50% of all our projects to actually be green finance. So of all the financing and all the financing that the bank, that EBRD does, 50% of it has to be green. Now, within that, the split of mitigation or adaptation, we don't have a specific split, and not for countries as well. What we have set, and this COP actually as well, is that we've actually set an adaptation target for us to deliver as a bank. But whether it comes from Egypt or from other places, it's a bank target that we've set. So hopefully that answered that.
I can add perspective from IFC. So for IFC, we do have a very hardcore target for climate mitigation projects. Have to be 35% of our investments. For adaptation, we do not have a target, but we have committed to increase our investments in adaptation. So there are two types of adaptation projects, kind of the way IFC is looking at. adaptation of the projects, basically the assets we invest in. Let's say if we invest in hydropower plant, it has to be resilient to climate change. That's an example of adaptation of the project. But also we're actively looking for investments that deliver adaptation through projects. For example, if you invest in desalination plant, that builds resilience of the entire kind of water system, right? So there is a difference, and I think where the big numbers will be are through in adaptation through projects. I am personally a bit worried about targets for adaptation through projects because we had a discussion earlier. One of the key constraints to putting resilience and adaptation measures by clients is their cost. So actually, having a target could create perverse incentive. We want those adaptation costs to be as cheap as possible for the client because then it's more likely that they will adopt them. And if you think about it, let's say if you invest $1 billion in a project and they invest $5 million to be resilient, you're actually strengthening resilience of $1 billion project. But based on the current methodologies, we would only count $5 million, which I think is just the wrong way of looking at it.
Yeah, I just wanted to compliment because I completely agree with the point of should we be measuring dollars, at least in the private sector. Maybe the public sector is different, but there are very limited amount of 100% private sector projects on adaptation. Generally what we have is a project that is a development project that has a component, a percentage, and generally that percentage tends to be smaller. At least in infrastructure, it's smaller. It could be a 2 or 3, a 5%. But as what the example Irina was just saying is the roads may be a $200 million projects that they add $5 million. So overall, it's a $205 million in a road, but the whole asset is resilient. So it's not that we don't want to increase adaptation. We have looked at it, how to do it, but putting an amount, it may be misleading because what we want to do is create a resilient system. So I think that we're finding that just counting the dollar amounts that goes specifically, at least following the MDB methodology, may be misleading because we need to look at a broader picture. I just complimented that point.
Thank you very much. If we don't have any more questions, I might still have one or two. And it's a bit of an open question to all of you, is what do you personally see as one of the most important climate risks that we should be focusing on? You're all coming from different geographies. Maybe there are some key events that you have witnessed even yourselves that you think we really should be addressing as the priority. It's a bit of an open question if whoever wants to go first.
So just a quick reaction, at least for Latin America and the Caribbean, it depends on the place. I mean, the geography is so broad, and even within one specific country, you may have in a country like Guatemala, say, areas that may be having floods and other areas that may be having droughts. You may have hurricane season in the Caribbean or tropical storms that are having an impact. And with La Niña right now in the winter, but it's the summer in South America, La Niña will impact soy production in Brazil and Argentina. So I don't think there's one impact that we should be looking at. I think it's based on the geography, based on the location, and giving, at least in the Americas, being so long, there's a diversity of impacts.
So perhaps just to complement a bit further what Helen said, the short answer would be it depends. So because it really depends on what is the sector, what is the country. But what we try to do when looking at those risks is we divide them into two types of categories. One of them are actually acute risks, so those risks that come in and they're a single event that has a substantial impact, so that could be a flood or a hurricane or a fire. The other could be chronic risks, which have an impact, a growing impact over time. So that's rising temperature, less waterfall, soil degradation that happen and take place over time. And then we look at both of those aspects, and each one of them has a stronger impact depending on what the location of the country, the sector of that country, and then on a project specific. Over time, once we actually start to look at a number of years of our portfolio, we will see where we're having pockets of risks increasing, and we hope to be able to perhaps calibrate those to that. But at the moment, we're really focusing on based on acute risks, chronic risks, sector and country based on location specific.
Thank you. Eva.
I can only concur with both Elaine and Effie, but I think what's happening, if we now we need to look at a systems approach, because even though for those chronic risks lead actually for some ecosystems to certain tipping points, and then lead to, for example, ecosystem collapses. So we are going to have to look at both. I don't think you have the one, the single event that then you need to recover from, but I think more significant now are these chronic risks, and how do other ecosystems or water also interact with that rise in temperature, for example, and whether that leads to then a collapse of another system on which livelihoods depend on.
Thank you.
If I can add something, of course, I've shared what my colleagues said, and I just would like to make the point on Europe. Actually, it's like before we were focusing more on physical climate risk in Africa or in Latin America, but today we can see clearly that this happens also in European countries. Like in the southern countries, we had lots of wildfires during the summer, and this already occurred a few years ago, and it's increasing and increasing. So I think this issue is definitely global and not only for the emerging markets.
Thank you.
Completely agree with what my colleagues have said, and I do support this kind of distinction between acute risks and chronic risks. I think chronic risks are particularly important to look at. And if I think, although every single risk is location specific, when I think about population expansion and where the future population will live, it's in cities. And I think cities in particular face very chronic risk of rising temperatures that has to impact how we plan cities, how we build to try to lower the urban heat impact, which is a health hazard, but also it's a drain on economy in terms of loss of productivity, and it has all kinds of other implications on people's well-being.
I think this week we actually surpassed the 8 billion mark of our population on this earth, so quite significant. We have a question. Welcome.
Hi, thank you. I have a question about scope. I'm curious to hear your views on some of the draft regulations you see coming up. You see supply chain included. I'm curious to see what your views are on that, and also if you see it going further than that. So if we also, private sector needs to look at communities, or sort of where do you see it going, and your views on what scope you should take into account. Thank you.
I can start off. So the scope definitely, and I think from our different environmental and social standards that we all have, supply chain is a key area of focus, and an increasingly important one, not only from a climate perspective, but also from an environment perspective. And just to give you, absolutely, if you look at dependencies, some of these corporates are dependent on certain supply and certain goods of which, are exposed to increased climate risk. So, it affects then their bottom line. So, yes, supply chain is a big topic. How we handle it is going to be a challenge. It already is a challenge from a due diligence perspective. You just also need to be aware, in the EU we do have the upcoming directive on environment and human rights doing environment and human rights due diligence in the supply chain, which includes looking at implications of climate. And therefore, this is going to have a knock-on effect, certainly on how we look at things. It does go down, of course. It's intrinsically linked, supply chain, with also communities. Absolutely.
Anyone else want to come in?
So I think it is important that within the context of now the process of Paris alignment, scope comes again and again and again, especially when it's not necessarily focusing on direct investment, but actually when we look at corporate finance, which is basically providing working capital to the counterparty. And so when we look at the counterparty or the anchor company, looking at supply chain becomes very critical because of not only, and back to the point, not only of the adaptation of the project of the company, but also the adaptation of the community or through the company to the community. And we have examples of having worked with a supply chain of, for example, a company in Mexico, a granola bar producer, that their suppliers of honey for the granola bar were impacted by tropical storms in Mexico, in the southern Mexico part. So what we did was work with the community, and it's an indigenous community, to help them basically produce honey and have more new queen bees to produce honey, and train them on how to manage the bees in a context of the tropical storm. The unexpected outcome of this is that the providers or the supply chain of the honey producers to the company, it became a loyalty issue because they felt that the company cared for them to be resilient to climate change. So a couple of years later, a new storm came about, and there were a lot of granola producer companies looking for honey. But these producers you were not here before. We want to work with a company that actually supported us and gave us strategies to become resilient. So there are impacts and spillover effects, let's call it that way, in the supply chain, that if we take care of the suppliers, it will be better for the company and it will be better also for the whole community.
Thank you. I think we're slowly running out of time. Maybe just a very quick wrap-up round. I'll let you all maybe say a few words about the next steps regarding physical climate risk assessments and maybe the challenges that you really want to focus on next. Eva, I give you the floor.
I think in terms of the next steps for us at the EIB is really going down that road of integrating physical climate risk, transition risk into our credit analysis, and I think that's the aim. But aside from that is also expanding that climate risk to environment risk, which includes biodiversity, and that's what we're doing.
So as part of EIB Group, of course, we have the same objective as Eva mentioned. Maybe one point that I would like to highlight in terms of challenges for us, so when we're dealing with SMEs and data at SME level is quite difficult to collect, and this is definitely a big challenge for us because if we want to improve our climate risk methodology, we need data from the SMEs themselves. So this will definitely be one of our biggest challenges in the future. In addition, we are also working on the ECB implementation, and so we have made a gap analysis, and we really want to be fully aligned with all of the recommendations by the end of 2024, like the regulation is aiming for regulated companies. So this is also a big milestone for us. And finally, what we would like to do is to continue increasing our transparency. So we have the TCFD report. I think I will have a look at all the reports from my colleagues here today and try to see if I can pick some good ideas. I heard a lot today, so that's good. And in addition, the idea is to improve the transparency with our intermediaries. So to communicate with them on our assessment of their climate risk, to make them aware, and to discuss with them during due diligence how they could improve it and decrease these risks. Because we definitely believe that we have to be all together to fight climate change, and it's not think to only IF but to all of us.
Thank you. Efe.
So perhaps to start with a nod to my colleague Helen is that this is a journey, and then you know, a similar nod to Stephanie as well. And data is a problem, so we know that that's there. But that's why perhaps one of the points that we'll be looking at more closely, and hence my question to you, is that we know the data isn't there. We know the challenges are there. From some of the discussions that we've had with regulators, they also accept it, they acknowledge it. But what they tell us ultimately is that we know it's not there, we know it's tough, just do it. And that's why we are looking at areas. What can we use as good proxies, as meaningful proxies for us to look at? We don't have all of them set up, so hence my interest in that area. And that's something that we're going to look at then, improving, developing our methodologies further to make them more accurate. And then in terms of actually, what are our kind of key priorities to actually do for next year? I think that the question that I get constantly asked by our management and our board is, great that you have these numbers, great that you know the risks, but so what? What does that actually mean for us as an institution? What does it actually mean in terms of the numbers, and do we have to make changes because of that? So improving our ability to do stress testing, understanding those numbers better, is what we're going to be focusing on as priority number one. Priority number two would actually be to collect the data, to get the data so that we can actually report better in a comparable way, and that relates to what's known as the financed emissions, so that's scope 3 for a financial institution, and that's going to be a big focus for us next year. And finally, very similar to the EIB and IDB as well, I suspect to all of us actually, is nature and biodiversity is definitely happening as well. There is going to be COP15 in December, and we're going to have an active participation there, and this is a start.
So in addition to all the things that my colleagues have mentioned about data and increasing the quality of the tools that we have, I would say that we need, or we will focus on getting more resources, financial and human, to be able to do this. I mean, all this is very important, but if we don't have the resources, we won't be able to achieve it. And the truth is that the fundraising to do this type of tools and to implement them takes time. The other issue that I would add to the conversation is continue the collaboration between ourselves. I think this is an example of that, how we can learn from each other and not duplicate, but actually collaborate in ways to make us get further together. And lastly, the awareness of our clients. They don't know that they're doing adaptation. They may not call it adaptation. And not only of our clients, our investment teams. Our investment teams may not necessarily know what adaptation is. If they understand it, they will be able to include it within their investments.
Thank you. So there are 3 priorities for us in terms of next steps. In the real sector, now that we have been rolling out Paris alignment methodology, we're working to develop tools and provide additional support to our investment operations. Because right now, Paris alignment methodology is rolled out by the climate team, which is a central unit that works across IFC with all of the investment operations. But we want to completely mainstream this process, so we're training environmental and social specialists, sector engineers, so that they are the ones who are doing the assessment of climate risks on each individual project that they're engaged in. So that's number one. Number two, financial institutions. We have to start piloting the methodology to assess climate risk associated with known use of proceeds in our investments with financial institutions, but also we need to start piloting the methodology for assessing climate risks in cases where the use of proceeds is not defined. This is the case with equity investments or corporate loans. And the third issue, just wanted to pick up on what was said about nature. So climate change is one of the key drivers of biodiversity loss, and biodiversity loss and climate change interact, and this interaction leads to increased systemic, financial, and economic risk. So we really need to start looking at where we invest, which sectors have very large dependencies on nature, and how the disappearance of nature is impacting those sectors and what type of risk it creates for us as financiers. So it will probably be a bit harder, but this is definitely an area that we need to focus on.
Thank you. Wow. I think I definitely have learned a lot. I hope you from each other and the audience as well. It's difficult to sum up. I've scribbled all around my notes here. I'm running out of paper. We mentioned Paris alignment, that this is really the basis of the MDB's framework, importance of TCFD, harmonization of the disclosure frameworks, whether with the help of regulators or ourselves in really cooperating together, templates to really compare the information and data that we are publishing. But also that putting a dollar amount to adaptation is not really maybe the best solution, because the whole asset that is financed really needs to be resilient. Pricing. So the client really needs to see the benefit of this investment, of this effort. And so I think the next step, several of you mentioned that it will be integrated one way or another into your pricing policies. And awareness raising within ourselves, in our institutions, with our different teams, but also with our clients, and really the links with the biodiversity and climate change. I think these are some of the main points I noted. I thank you all very much. I think it's been really interesting. The ones listening online, I'm very sorry we couldn't take your questions due to the technical capacity, but if you reach out to us, EIF, over social media, I'll make sure that all your questions get to the right panelists, and then we will try to seek answers. And I think we're very well good on time as well. So thank you all for listening, and have a nice afternoon, and thank you for my amazing panel.